Imagine needing new boots, but only having grain to trade. You have to find a bootmaker who specifically wants your grain. This is the barter system, the original, clunky form of trade. It's difficult and inefficient because it requires a perfect match of needs, which held back complex economic growth in early societies. That specific requirement is called the double coincidence of wants. For every trade, both parties must want what the other has. If the baker needs a coat and all you have is a shovel, the trade fails. This made specialized jobs, like being a full-time potter, very difficult, as people spent too much time searching for the right trade partner instead of producing goods. The invention that solved this was money. Money is anything widely accepted for trade. When a farmer sells grain for money, they can use that money to buy a tool from anyone. Money acts as a smooth, universal bridge between two people with different needs, making trade faster and easier. The first job of money is the medium of exchange. It lets you sell your product, your labor or crops, for a value token, money, and then use that token to buy something entirely different. You don't have to offer the store your old school books for a new phone. You offer money. This separation of buying and selling dramatically increased the volume of early trade. Money's second role is the unit of account. It gives everything a common price tag. Instead of figuring out how many pots equal one sheep, both are valued in a standard unit, like a silver coin. This clarity and fairness allowed marketplaces to standardize prices, making transactions simple and trustworthy for everyone involved. The third function is store of value. Money holds its purchasing power over time. Unlike perishable goods used in barter, like grain, metal coins won't spoil. This encouraged people to save and accumulate wealth for the long term, which was necessary for funding large generational projects like grand temples or advanced infrastructure. The earliest forms of money were things with value on their own, called commodity money. Examples include salt, the root of the word salary, cattle, or durable cowrie shells. However, commodities were hard to divide. Try paying for a small item with a cow, and often heavy to transport, pushing societies to find a more convenient substitute. The next step was using weighed metals, specifically gold and silver, in civilizations like Mesopotamia. Metals were rare, durable, and easily portable, making them a better currency. However, merchants still had to carry tiny scales to weigh the metal and test its purity every time, which was slow and subject to cheating. Around 600 BCE, in the Kingdom of Lydia, the world saw the first standardized coins. The king stamped the metal, guaranteeing its weight and purity. A merchant could now simply look at the official stamp and trust the coin's value, instantly speeding up trade and cementing the king's authority over the economy. Standardized coinage was vital for the growth of large empires such as Rome. It allowed governments to collect taxes efficiently and pay huge, distant armies in a dependable currency. Economic stability provided by a unified currency is a foundational component of political and military power, enabling empires to govern vast territories. The very first banks were often temples in ancient societies like Babylon and Greece. People stored their grain and metal there because they trusted the priests and the temple's security. Merchants later formalized this, keeping careful records of deposits and even giving out loans, showing that the need for a secure financial institution is thousands of years old. In medieval Europe, people turned to goldsmiths to store their gold, as they had the most secure vaults. The goldsmiths issued receipts for the deposits. These receipts, simply proof of ownership, were the precursor to paper money, as people quickly realized they could trade the receipt instead of the heavy gold itself. The goldsmith's receipts became the first true banknotes. You could pay a debt by handing over the receipt, trusting that the goldsmith would honor it later. This switch from carrying heavy metal to carrying light paper, known as representative money, was a major boost to long-distance trade, saving time and greatly reducing the risk of being robbed. The core service of a bank is accepting deposits. The early bankers noticed that most people rarely withdrew all their wealth. They had a huge surplus of gold just sitting idle in their vaults. This pool of inactive capital was the key discovery that allowed banks to transition from being simple storage facilities to becoming financial engines. The most economically important function of early banking was lending and loans. Banks realized they could loan out a portion of that surplus gold to merchants and entrepreneurs who needed money to start ventures. This act of lending infused capital into the economy, promoting specialization, innovation, and overall wealth creation. Banks profit by charging interest, a fee for borrowing money. A borrower repays the principal plus an extra amount, the interest. This profit allows the bank to pay the original depositors a small fee for saving their money. This system creates a powerful positive loop. Saving leads to more lending, which drives economic growth. The rise of banking helped power the great trading cities of medieval and Renaissance Italy, like Florence and Venice. The sophisticated financial systems they developed allowed trade to flourish without the slow, risky transfer of heavy metal across continents. The wealth generated by these banks fundamentally financed and accelerated the Renaissance itself. For large-scale international trade, the bill of exchange was invented. This was essentially a note that ordered a foreign bank to pay a specific amount of money deposited elsewhere. A merchant in London could pay a partner in Italy without ever carrying gold, making long-distance commerce safer and much quicker, acting as an early form of a check. As banks gained power, regulation became essential to protect the public. Even ancient texts like the Code of Hammurabi included laws on interest and debt. Early regulation was focused on keeping bankers honest and preventing excessive fees, ensuring that the system remained trustworthy, which is the bedrock of any successful economy. The journey from simple barter to complex banking is the evolution of civilization itself. Money and banking provided the stability, speed, and capital needed to move beyond subsistence living and build complex, interconnected global economies. A stable financial system isn't just a convenience. It's the engine that drives large-scale development and prosperity.